One of the things that makes One Retail at a Time channel different is we bring on experts with specific domain expertise. And we have the boys, Jonathan and Dustin from Convoy Home Loans. We're going to talk about the Fed rate increases, 10-year notes, mortgage rates, regional bankings, all kind of stuff, because these guys are in the mix day in and day out. How you doing, Dustin?
Good. How you doing, Mike?
I'm doing all right. Jonathan, yourself?
Surviving.
So why don't we talk regional banks first? Because this is, I'm going to guess regional banks are in your purview. Probably some of your partners are regional banks. It's been quite the kerfuffle the last, I don't know, call it 6 weeks, with more noise coming today. So are you hearing it? Are you seeing it? What's going on regional banks?
Yeah, we're obviously hearing it and we're seeing it. Over the last couple of years, like we actually do a lot of business with regional banks, and obviously with the recent news of this week with First Republic being acquired by one of the big four, right? And now PacWest seems to be the next kind of that the market is kind of targeting, right? And they're saying they're going to be next, which kind of seems imminent. But I think the biggest thing to take away from it is that the clients that we used to have were the investors that would get these private client type rates that nobody else could get, right? Because they had 2 or 3 million in deposits. We're probably going to see that dissipate quite a bit, or the margin between, let's say something we could offer or a bank could offer that's not a regional bank is definitely going to be, in terms of the margin, shrinking. It's not that we don't believe they're going to be around. There's a lot of regional banks that are still, very strong on their balance sheets, but the appetite for these types of loans just don't make sense in this is current, economy and market.
Yeah. Yeah. One of the things that I'm seeing out there, I just got back from a multifamily event, and there was an acknowledgement that, operators, which people in the audience were operators, right? They have debt that's coming due, right? 5-year terms, usually on commercial stuff. And some of their regional banks aren't going to refi them. They need the cash. They want the loan paid off. So you have to feel that if they're doing that on performing notes, that they are going to get tighter on new loans as well. It kind of makes sense, I would think. What do you think, Jonathan?
Yeah, absolutely. And I mean, a lot of our clients that are in that space, especially if they did like 3-year, 5-year adjustable, I think is the biggest bucket right now that's in trouble. Right.
Yeah.
Because if you think about it, 3 years was 2020, 5 years,
Ooh,
2019, right?
yeah.
So you're kind of looking in that range of like, even if you did a 5-year in 2020, your adjustable is coming up in 2 years, right? And if you're not stabilized at that point, you're in for a whole boatload of trouble, right? So
Yeah.
um, a lot of our clients that actually, like, even on 2 to 4 units, that some of them went to the commercial route because they were like, oh, commercial rates were down. They were like down in the threes and twos while we were in the fives, right? So they were
Yeah.
like, oh, we're just gonna go commercial and do a 3 or 5 year adjustable. And now they're hitting us back up, being like, hey, I should have
Yeah.
listened to you
Yeah.
guys.
Whoops.
I should have just gone fixed, and I should have just listened to you guys and done a longer fixed period because this can happen. So now we're working with a lot of those clients, especially because a lot of those were regional banks too, right? They were the local banks, regional banks. They were like, oh, they're offering me this
For
crazy,
sure.
and now they're in a situation where they can't refinance out of that. So we've actually been like re-evaluating a lot of our relationships with regional banks that
Sure.
we've been working with, expanding out a little further. Just because I know that in order for us to be able to service more clientele this coming year, we're doing more research on the bank balance sheet than ever before. Rather than the terms they can offer and anything like that,
Right.
one of the things that we're really looking at is before building like a referral partnership, it's, hey, how is their balance sheet? Can they actually service the clients we're sending over? Because if they cannot service those clients, then there's no point, because they're probably
Right.
going to go belly up in like 2 months, right? And it's funny because PacWest and Dustin, I think, correct me if I'm wrong, they were the bank that was buying a lot of like that we had a lot of clients using Civic, and they were the ones buying a lot of Civic loans, and Civic went under, obviously. because they were writing these risky loans like that we were like, well, I don't think it's going to work out. And
No,
PacWest,
that's not a good loan. Yeah.
yeah, PacWest came in and they just did everything and
Wow.
just overhauled the whole thing. And then now PacWest is under a lot of trouble, right? So I think that we're going to see a lot more of this happen, which is funny because they were talking, oh well, banking crisis is over. It's like, no, that like SVB and Signature Bank were just the beginning. Now it's coming down, and I think we'll see a couple more really
Oh,
just,
for sure.
and get swallowed up. And who knows, maybe JP Morgan just becomes the the number
The
one,
bank.
yeah, for everybody.
It's both the number one bank and the last bank. I mean, it's just the
Yeah,
only one left. Yeah.
who needs
It's
Bitcoin
crazy.
if you have one bank?
Yeah, exactly. Yeah, well, let's talk about the Fed decision because I think it's certainly in the residential space. I think we're gonna see some rate compression over the next 3 to 6 months, and it may not even be 3 months. So yesterday, what happened is we got the Fed rate decision, which all three of us predicted. It was a no-brainer. I think all three of us also said that they're going to pause for quite a while now. I was hopeful he wouldn't use the pause word, which he did. So now what's happening already is the 10-year note is crashing. I suspect that 30-year mortgage money was down yesterday. I didn't check, but I think it was. I think you're going to get 2 and maybe 3 repricings today. I think mortgages are going to come down. And then finally, we're going to see that crazy margin start to come in between the 10-year and 30-year rates. Lots of stuff going on in residential. What do you guys think?
Yeah, I mean the sticker shock was not there. Everybody knew 0.25 was going to happen, right? I think I was kind of hopeful that Powell would be a little bit more hawkish. He was, as far as dovish, or if you want to call it maybe a pigeon equivalent, right? Like he made it clear so that the markets now are I don't know what it was when I was reading this morning, but like the market thinks now that there's going to be maybe 2 or 3 cuts. I'm
Yeah,
still
so I read it this morning, Dustin. So this is why he should have been a hawk. He wasn't. 98% prediction of a pause in June, 2% cut. Nobody's talking about a raise in June. And
yeah.
to your point, they are pricing in 3 rate cuts this year. Opportunity missed, pal. You wimped out.
Yeah, it doesn't help. I mean, like I do think we're gonna pause for a little bit, but
Yeah.
leaving that option or possibility of there still being a rate increase is what really is going to make this more difficult, because of the fact that this has happened a lot this year, but rates went up 0.25, the 10-year went down 30 basis points. Now we're at
in 2 days. It's down 30
3
basis points in 2 days, and the Fed raised.
exactly. That's
crazy.
That doesn't work. So I don't know. I think we are in for a 3-6 month, or at least through the end of the year, a slow trickle down in rates. We're not going to see it go from, I think the average 30-year right now is 6.3. I think we could get sub 6, right? That's
for sure.
Definitely
not 5 though, but sub 6.
But the problem is that we're seeing it now. Like affordability is going to be easier for people buying, but the problem is still the fact that inventory is not going to be fixed. And that's the housing, quote unquote, crisis that we're still headed to because of this.
Absolutely. This is all kinds of bad. Jonathan, any thoughts on this?
No, I mean, we're seeing it very active in the field. I have a lot of friends that are, I guess, younger and leaving they're getting fired from tech, or they're in tech, right? And those guys are starting to have I should get into real estate, right? And everyone's trying to get into real estate because
interesting.
Yeah, it's kind of weird. They're like, I get so many text messages every day. I'm sick of my corporate job. I'm hate this, I hate that. So to Dustin's point about like affordability and such, I don't know if it's actually, I mean, that group of people are the next group of buyers, right? Like like Dustin's age, like we're the next group of like buyers. And even they are like, they don't want to work, they don't want to do anything, they just want to like, I just want to invest in real estate. And it's like, do you know what that means? Like,
are you bankable? Yeah,
like affordability, like that, I don't like, that's not getting any better, right? So I think especially with the kids that are just leaving jobs without responsibility, like, I'm leaving, I'm 2 years history, like whatever, and that's not going to help us at all. But obviously we do still have a lot of clients that are waiting on the sidelines with cash. So we are hoping that, we are hoping that there's a bit more inventory, but the only people selling still are going to be people that need to sell, not
Yep.
people that can wait. Yeah.
Yeah. The move up market is the largest part of the market because there are 2 transactions, and they just don't have to. They don't have to. They don't want to. There's financial reasons not to. I mean, it's just all kinds of messed up. So it's going to be interesting. So if I were to say, what day is it? May 4th. Let's pick July 4th. Do you think the 30-year mortgage rate is sub 6 by July 4th, 2 months from today? Yes or no? What do you think, Jonathan?
Sub 6.
Wild ass guess.
Sure.
Dustin?
Yeah, I mean, we'll see what more economic pressures get put on by the feds, because if the regional banks, keep dropping, say 2 or 3 by then no.
Okay. All right, we got one on both sides. So I'm going to come on. I think by July 4th, we're below 6. I think we're at the terminal rate. I think from here, banks realize that Fannie and Freddie are the only game in town, and they're going to compete to sell deals to Fannie and Freddie, right? The commercial market's in all kinds of pain, but Fannie and Freddie are going to keep buying. So that's what I'm thinking. But anyways, if somebody want to reach out and see all the amazing programs you offer, how should they do that?
Go to convoyhomeloans.com and let us know you came from more at.
There you go. Thanks, guys.